Good morning, good afternoon, good evening, folks. Michael Zuber back with his Friday guest, Mr. Stephen Dow. How you doing, sir?
I'm fantastic. And yourself, brother?
I'm doing great, man. So we missed you for a couple of weeks. You were being a good son. You're moving your mom from California to Texas to live with you. So shout out helping mom. That's awesome. So good job.
Thank you. Thank you. A lot of like business traveling as well, obviously. And because I'm doing like so many shows. I think I got one more left actually in Houston sometime in November, but that should hopefully be the last of it, because it's not good to travel during this time of the year. You always get stuck in the plane or delays. It's horrible.
Well, hey, one of the things I wanted to do, because I know more and more of the one rental at a time community is reaching out to you, seeing if you can help self-employed, they don't tax return, all that stuff. So I thought what we should do is just paint in broad brushes fees that are often involved with lending, let alone whether it's bank or non-QM or hard money. And I'll take a shot at this. You can wrap around it where I misspeak misspoke, whatever. Right. So when I think about the fees, and again, I've done deals with banks. I just completed 2 with yourself at Velocity Mortgage. Right. I think there's kind of 3 upfront fees. There's always a processing fee. Right. Because your organization,
touch your paper.
The lender has to pay processors and all of this. And they're in my opinion, not yours, my opinion, they're okay breaking even, but they're not going to lose money on paper, right? Because I don't know what the ratio is, but not all loans are approved, right? So they want to at least break even on the nose. So there's absolutely processing fees. They may be disguised as other things by other lenders, but generally speaking, I think there's always a processing fee. There's also always, in my opinion, appraisals, whether you're doing a residential or commercial purchase or refi. The lender wants to know about the asset, right? And that's
that's the only collateral we got, especially in our case when we don't verify income. I mean, we just need that FICO score and a quality property, and pretty much else is
Yeah, it's funny. I just saw a post yesterday. I think it might have been the day before, that FHA is actually going to approve or validate. What do they call them? Drive-by appraisals now, or no, desktop appraisals. I'm like, oh my God, are we repeating some of the mistakes before? But anyways, but again, the lender is still trying to basically validate the asset that is going to be collateral. So again, makes total sense. And if you don't know, folks, a residential appraisal is cheaper than a commercial, like by several factors, right? A commercial appraisal is definitely more, thousands of dollars, where a residential is hundreds of dollars, just so my opinion. And then there's always title, or sometimes I call them escrow fees, but title fees. Basically, somebody's validating that the asset, again, has, clean title. Yeah. So that
they've done all the homework. They insure against any future, instances of liens or judgments. So
exactly. So there's all of those things all the time. Every lender, they may be called different things. In my 20 years, I remember 20 years, or I don't know, maybe it was 15 or 16 years ago, they were saying no appraisal fees, no appraisal fees. You know what they did? They created another line item in another box and called it something else. And a lot of that has been cleaned up with Dodd-Frank. But again, you will pay a processing fee because no lender wants to lose money. They're fine breaking even, my opinion. 2, there will be an appraisal fee. The asset needs to be reviewed by a third party. And then 3rd, escrow or title fees, because again, somebody's going to do the work on the asset to make sure that the new lender has a first or second position, whatever that loan is. Is that fair?
That's fair. And typically with the escrow and title, they also ensure that all parties involved, as far as buyer, lender, seller, in the case of a purchase, all do what they're supposed to do contractually. And then they're the ones that kind of, schedule the signing, record the
move the money around, right? It comes here, then it goes there.
And then, pull the trigger on the execution, tally up all the numbers. So just make sure that everything's, balanced out. But yes, that's primarily most of all the fees involved. If you're talking just from the lender standpoint, there's also, most of the time, you normally have to apply with a loan professional, because like myself as a lender, I don't go direct to consumer. It's business to business.
Oh, so there's
correct. One extra person or entity that you'd have to
they're going to have their piece. Right.
Correct. So again, you would apply with them. They kind of combine your paperwork, and then they basically broker out or try to, fish out or search for the best programs based upon your specific needs. So in my case, I'm the actual lender. So mostly
Right. So let me just kind of repeat that back. I want to say it in my words. So again, and I want to relate to Matt, the mortgage guy, right? Another right. He's a guy that comes on Wednesdays, residential lending, owner rocks, again, stuff you don't do, right?
Correct.
He's essentially creating a package, right? So that package can be submitted to their online system to get a yes or no answer, right? So he's again paying, he has a whole team, right? And that's why he just changed offices. Now he could do the entire country. But I guess, did he change? I don't know, whatever he did. Go watch his videos. I forget what he did. But anyways, now he can do 50 states versus just California. Nice. But there's fees in that, right? Because he's got to pay his staff. Again, he's gonna, I'm sure he's fine breaking even, but he doesn't want to lose money. Okay. Right. So that's all the upfront fees. Those can be compared, right? You can compare and contrast. A lot of them will be fixed, like appraisals. I think since Dodd-Frank are kind of set, right? They're this and they're that. Maybe they're different by state. But then I think they're the actual loan. I think there's one more fee we have to talk about. I don't know if a fee is the right word, but that's what I'll call it. And that is points. Right. Points are things that lenders use to either de-risk a loan. Right. Because again, they're essentially, to me, again, not a lender, not a broker, don't pretend to be one. Essentially, a point to me is prepaid interest. Right. It's kind of, that's how I see it.
In some capacities, depending upon what you're using that point to do, because from a lender standpoint, that 1 point or 1 percentage point, it can be used as either to buy down the rate or, sometimes buy down your prepayment penalty, or offset some other, options for the loan itself, as far as just terms and things of that nature. So it can be allocated in different ways. So,
and that's what I want to get to, right? Points like when somebody reaches out and says, "Hey, I got a quote and it had 2 or 3 points on it." I thought we should realize what might be in that, right? Everybody's situation different. Every lender's different. Right. One of them, one thing is you'll see points if the loan needs to be de-risked. Poor credit score, not enough down payment, right?
Correct.
A 50% LTV versus 75. A 75% is more likely to have an LTV or a point than a 50. And it's just different. They're de-risking a loan, in my opinion.
Well, to some degree, because to get that more competitive rate that the bar is going to want, due to their maybe circumstances that, like you say, maybe seem more risky to the lender, they could use that percentage points to buy down that rate.
Well, that's where I'm going. That's
like you said, they're kind of prepaying the interest, and that kind of offsets our risk.
Yeah, well, that's where I'm going next, right?
Okay.
Box one is riskier loans,
right?
More likely to have points because they're risky.
100%. Right. To generalize and
Now, number two, you as the borrower, once your situation is declared in box one, you can pay points to buy different things down, right? You want a lower rate? Well, I like on the loan you did for me, I paid a full point, both loans, to get a lower rate both times, right? I'm like, I'm going to own these properties forever. I want the best rate possible. I will prepay some interest, right? Or at least that's what I told myself. So again, one of the things you could do is you want a lower rate, pay an upfront point, or even sometimes 2 points. Don't know, but that is one thing. Another thing is if you want a lower prepayment penalty, right? Maybe it's you want a 1, 2, 3 versus a 1, 2, 3, 4, 5, 6, 7, or whatever it is. Right. You can pay a point to shut that down, right? I chose not to pay that point because I'm like, I'm going to own 30 years. I don't care. If you want a 7-year prepay, I don't care.
399, 30-year fix. Come on.
Yeah.
Why would you want to get out of that?
Yeah. Go ahead. Do a 7-year, which, oh, by the way, I've never done before, but I'm like, doesn't matter. 3.99.
Doesn't matter.
Right. Or 4.99 on my commercial cash out. It doesn't matter. Right. So again, when you're looking at quotes and you see all these numbers and it looks expensive, I want people to break them down, right? There's the upfront paperwork, processing, appraisal, escrow, and title fees. And then there is your situation. What do you want to do? How risky or non-risky is the loan? And then what are you choosing to do? Again, I chose to pay points. I chose to add points because I wanted to buy down the rate. I didn't have to, but I would have had a higher rate. So,
but it makes sense when you do the math calculations. You might seem like, oh, I'm paying so much to buy down, but when you calculate the recouping period of the payment difference between not paying the point and paying the point to get that lower payment, you normally recoup that depending upon how much you're buying down within a 22 to 47 month, sometimes maybe a little bit longer period. But after that, you're ahead of the game. So you're talking 26 years of benefit. I mean, so.
Yeah. The other thing I want to highlight is This is again my experience with hard money back in like 2010. So this is not today, not Velocity, but a hard money lender in San Mateo that I used repeatedly. He
Right.
charged me 3 points just to get in the game,
Right.
60% LTV of purchase.
Right.
Actually, it wasn't even loan to value, it was purchase,
Right.
whatever was lower. And then like $3,000 in processing fees. And then
Right.
it went up from there, right? Like 3 points was his base, and I
Right.
may have to pay more.
Right.
But the reason I did those loans, and I would even call those expensive. The reason I did the loans is my only other option was paying cash.
Right.
Right. If you're going, like I'm going to you as a non-QM lender wanting 30-year fixed rate mortgage on my office building,
Right.
I didn't have a choice, right?
Right.
I could squawk, I could scream, I could do this, I could do that. But if I want cash out of my office and 30-year money, I didn't have another choice. Right. So it was either not do the deal or do this. So some of the times investors who do have access to bank money,
right,
and then they come here, they look at the fee structures. It's a different business, right?
Correct. Correct. Well, I mean, I think for the most part, most of the people that I've come across kind of understand the dynamics, but still from one rental at a time family, I try to structure the best cost effective, deal possible given their circumstances and everything else. So
you won't beat bank money if they can get a bank loan on an investment.
100%. Yeah, I always say that first and foremost.
Yeah.
Yep. If have you exhausted all your resources for conventional financing? If you haven't, I would try that route first, then come and talk to me.
Yeah, because if you can't get it for some reason, self-employed or whatever,
right.
Non-QM is a lifesaver for most investors who get past 10. Otherwise, you're paying cash or you're having
100%.
variable rate loans, and I wouldn't touch a variable rate loan today if you put a gun to my head. So
well, not in this environment. Not right now. No.
Rates. I talked to Matt, the mortgage guy. They went up an eighth in a day. A day. That's folks that don't know the market. Moving an eighth in a day is like it happens, but it's very rare, right? That moved in a day. So again, folks, if you want to consider a non-QM lender, one that I have used, reach out to Stephen Dow. How do you want them to do that?
sdow@velocitymortgage.com. And again, put ORAAT only as far as the acronym for one rental at a time in the subject line. I think what's working better now is as soon as they email me, I'll or include actually a telephone number where they can be reached at quicker, because the emails that are flooding in alongside with my normal business for the company, I'm just getting overwhelmed. And so there's just not enough time because some of the emails get lost in just the flooding. So phone number, then I can call you right back because I can talk faster, obviously.
You're not slow.
No, not at all. So I get a lot quicker done with the phone call than I can with emails, because there's a lot of back and forth and they don't know what they don't know yet as far as giving me just the basics of what I need to give them a quick, accurate, answer. So it's a lot of times like, oh, I still need this. And then, oh, but what about this? And so it's just a lot unnecessary back and forth when that
I like that
call, 5 minutes, boom, we can bang it out.
I like that. Again, folks, ORAT, ORAAT in the subject line, and then include your phone number so we can call you back.
Best number to reach you back at 5 minutes or less is typically what I'm trying to achieve. I mean, maybe I set the bar too high as far as 5 minute response.
Yeah, dude, come on. Let's say 15 minutes.
15. I know, man. You always
set the bar and jump over it.
Right. Well, my service, I'm always known for my service. I always pick, so I'm always driven to kind of excel. But no, you're right. 15 minutes, if possible, is all I'm asking for.
There you go. Thanks, buddy. We'll do one more show. Thanks, buddy.
Thanks, man.